Hi, my name is John Palmer, Senior Vice President and Head of Liquid Real Estate Strategies for Westwood. I wanted to take a couple minutes to share my thoughts on the REIT market for the month of August, but as usual, I'll preface my REIT industry comments with some quick commentary about the macro environment. August was a busy month as we wrapped up the Q2 earnings season, which generally came in quite strong. And we also received several important macroeconomic reports, the most important of which was the August jobs report, which provided further evidence that the U.S. labor market is cooling. In the report, the Bureau of Labor Statistics indicated that the U.S. economy added just 22,000 jobs for the month of August, which was significantly below expectations of about 75,000 jobs. Further, the government revised down its earlier numbers from this summer, indicating that in June, the U.S. economy actually lost a net 13,000 jobs in the month of June, which would be the first negative month since December of 2020. As a result, the unemployment rate ticked up to 4.3% in the month of August, leading most market commentators to speculate that a rate cut at the upcoming September FOMC meeting is a near certainty. And the debate about the future path of rates obviously leads us to inflation. The July inflation print came in at 2.7% on an annualized basis, which was flat from the previous month. Again, while it's still on the lower end from a historical perspective, it remains above the Fed's 2% target. Next week, we will get the August inflation data, which will loom large as it will be the last report before the FOMC meets. On the first slide, we show the 10-year Treasury chart for the first 8 months of the year. The 10-year Treasury started the year at 4.57% and ended August at 4.23%, so nearly 35 basis points lower. However, as you can see, there has certainly been a fair amount of volatility during the year-to-date period. Switching to REITs, on the next chart, you'll see the year-to-date performance for the MSCI US REIT Index. Again, we've had a fair amount of volatility year-to-date. This index started the year a little above 1,300 and ended August at 1,320. So it registered a positive return of about 3.5% for the first 8 months of the year. To put that in context, the S&P 500 was up 10.8% year-to-date through August, and that leads us to believe that there is the potential for a nice reversion to the mean trade in the months and quarters ahead. Breaking down the most recent performance by property sectors, on the next slide, we show August was a very, very strong month for publicly traded REITs, with nearly all property sectors in the green. In particular, regional malls, lodging, self-storage, and office led the pack, whereas specialty REITs and data centers were slightly negative for the month of August. Lastly, I thought it would be helpful to show the change in valuations over the past year. As you can see on the last slide, implied cap rates for the most part have remained fairly steady over the past 8 months. However, the noticeable sectors would be data centers, which have seen cap rates widen a fair amount, and healthcare and industrial REITs seeing meaningful cap rate compression. But the overall implied cap rates for REITs currently sits in the mid-sixes, which still remains a little wide to long-term historical averages. As always, thank you for your time, and if you have any further questions, feel free to reach out to Westwood directly. We look forward to sharing further REIT updates with you in the future. Thank you.